Welcome to the Deep Dive. Our mission here, as always, is to cut through all that noise, take a look at some dense sources, and hopefully deliver the knowledge you need to feel truly well-informed. Today, we are wrestling with, well, it's a classic retail puzzle, but it's wrapped up in a pretty big financial mystery. We're talking Lululemon, ticker LULU.
Yeah, and this one is really defined by contrast, isn't it? If you've been tracking Lululemon in 2025, you've seen nothing short of carnage.
Carnage is a good word for it.
The stock has just plummeted. Depending on your source, it's somewhere between 46%, maybe even 58% year to date.
Wow.
And for a company that was, the absolute definition of premium growth, this signals real panic among investors, genuine fear.
That terrifying drop, it's being met by what you might call the ultimate contrarian signal. We are talking about Michael Burry.
The Michael Burry.
The man himself, the one who famously spotted the housing crash, the investor known for identifying these catastrophic mispricings. And he is betting heavily that the market has got this all wrong.
And what's really fascinating here is the sheer calculation behind the move. It's not just a gut feeling. We found out from the recent institutional 13F filings.
Right, those quarterly disclosures, the ones the big investment managers have to file.
Exactly. Cyan Asset Management, Burry's fund. And it showed he didn't just, hold his Lululemon position. He actually doubled down.
Doubled down. From what to what?
In the quarter that ended September 30th, Cyan lifted its stake from 50,000 shares right up to 100,000 shares.
Okay, so a big increase.
A very big increase. And that position is now valued at a pretty significant $17.8 million.
So, okay, this really sets up the central question for our deep dive today, doesn't it?
Absolutely.
Why is this legendary purveyor of pessimism, the guy who looks for bubbles, making a multi-million-dollar purchase of what, let's be honest, looks like a falling knife right now?
The market seems to be pricing in some kind of structural, maybe even terminal decline for Lululemon.
Right.
And yet Burry is apparently viewing this steep collapse as, well, maybe a historic buying opportunity.
So to try and answer that, we really have to perform, I guess, a kind of surgical dissection of the company.
Yeah, we need to identify, weigh up, and analyze the reasons for this current decline.
Yeah.
The stale U.S. product everyone's talking about, those crushing import tariffs.
Against the core strengths, right? The things that might justify Burry's confidence.
Exactly. The international growth engines, that unique customer loyalty they've built, the financial fortress beneath it all.
Okay, so that's our mission today. We're going to try and figure out if this is a smart value play or just a classic value trap.
Okay, so before we dive headfirst into the current crisis, I think it's really important we understand the, let's call it the premium DNA of this company.
Good point. This isn't just any old apparel stock.
Not at all. Lululemon, really since it was founded back in '98, has consistently outperformed expectations. If you look at the last 12 months, ending August 2025, LULU pulled in $10.7 billion in revenue and, maybe more importantly, generated $2.4 billion in free cash flow, or FCF.
And that FCF number, just to remind everyone, that's the cash left over after they've paid for everything needed to run the business and maintain their assets.
Right. It's the money they can actually use for dividends or buying back shares or investing in future growth. So $2.4 billion in FCF really shows you this is, or at least has been, a highly profitable operation.
And historically, the stock performance reflected that. Since the IPO back in 2007, the stock compounded returns by, an incredible 13.2 times.
Unbelievable, yeah. 13.2x. Just phenomenal.
The truly phenomenal track record. But, and this is the kicker, here is the psychological shock that's driving this 50+% stock decline we're seeing.
Yeah.
For years, Lululemon was seen as this perpetual growth machine, right? And it consistently traded at a sky-high valuation.
Exactly. You mentioned the PE ratio, the price-to-earnings ratio. For Lululemon, it was often north of 40.
Which is huge.
Huge. And when a company trades at a PE that high, investors are basically saying, we believe your earnings are going to grow exponentially for decades to come. It signals this premium, almost untouchable status.
Right. Confidence baked right in.
But today, because of the market's reaction to all this recent news, that multiple has just collapsed. It's cratered down to the low to mid-teens.
Low to mid-teens. So like what?
We're talking a current trailing PE, maybe around 11, and a forward PE, looking ahead, maybe around 13.
Okay. That is a world away from 40. That kind of severe derating, that's usually reserved for businesses that are facing oblivion, right?
Pretty much. Think about it. Going from a PE of 40, which implies massive future growth expectations, down to a PE of 11, which implies, well, very slow growth, maybe even decline, and definitely huge operational risks.
It's like the market is completely reclassifying Lululemon from the sort of luxury growth tech stock to just a standard struggling retailer.
Yeah, the market is clearly pricing in some kind of existential threat,
Right.
which forces us to ask the question, what made Lululemon so premium in the first place?
Right. What is this moat that Michael Burry might be betting on?
Well, going back to 1998, they really built their business on 3 foundational pillars.
Okay, pillar number 1 was niche focus, wasn't it?
Exactly. They didn't start out trying to take on Nike or Adidas everywhere. They hyper-focused, specifically on women's yoga apparel.
A vertical the big players had largely ignored.
Precisely. And that allowed them to build real expertise, real technical depth in that area.
And that focus, it's still visible in their financials today, right? Even with all the expansion they've done.
Absolutely. The women's segment still makes up about 63% of their annual revenue. That's around $6.7 billion. They still dominate that space because they went deep before they tried to go broad.
Okay, pillar 2. And this feels crucial for the brand loyalty aspect. It's their direct distribution and community model.
Yes, this is so important. They deliberately built their stores not just as places to sell things, but as community hubs.
Right, I remember the free yoga classes, the local ambassadors.
They fostered loyalty through word of mouth, through experience, rather than just splashing cash on expensive celebrity athlete endorsements like everyone else.
And that direct model, it has huge economic benefits too.
Critical benefits. Lululemon generates, get this, 90.5% of its revenue direct to consumer.
90%.
Think about that efficiency. By keeping tight control over that customer relationship, they get better data, first-party data, and crucially, they keep the margin that would normally go to a middleman, like a department store.
And that control leads to some pretty staggering efficiency metrics.
It really does. Their sales per square foot, apparently 1.7 times higher than Nike's.
Wow.
And their operating margin is nearly double Nike's.
Yeah.
So structurally, they are just built to be more profitable than their much larger competitors.
Okay, and the third pillar finally, premium products. This is where the price tag justification comes in.
Yes. They built their whole reputation on proprietary, highly technical fabrics. Things like Luan, Nulu, Everlux, names their core customers know instantly.
That Align pant, when it came out, the feel, the fit,
Yeah.
it felt revolutionary at the time.
It really did. And the proprietary nature of those fabrics gives them valuable intellectual property, IP, and crucially, it gives them pricing power.
They could charge more because nobody else had exactly that feel.
Right. And it's important to grasp that category killer concept here. The Align pant was revolutionary not just because it was great for yoga, but because it seamlessly transitioned into comfortable all-day athleisure wear.
Which was a massive trend they caught perfectly.
Perfectly. And this allowed Lululemon to consistently position itself above the mass market. Their goal was never about selling the most units at the lowest price. It was always about exclusivity and quality, justifying that higher premium price point.
So that 3-pillar DNA, niche, focus, direct community, premium product, that's the fortress Michael Burry is presumably looking at, while the rest of the market seems to be running for the hills.
Okay, so that's the foundation. Now let's pivot to the sources of the current panic. Because the stock collapse wasn't random, it was directly triggered by those disastrous Q2 FY25 results.
Right, the ones covering the period ending August 3rd, 2025.
Exactly. Now, total revenue growth actually hit $2.5 billion, which sounds okay.
What?
But the headline number that absolutely terrified the market was this. Global comparable sales growth was only 1%.
1%. Ouch. And comparable sales, just to clarify, that's sales from stores open more than a year, right? It measures underlying health.
Precisely. So a 1% increase globally means Lululemon generated basically no growth in its existing footprint worldwide. That's bad enough.
But it gets worse when you drill down.
Oh, yes. That global number actually masks an even uglier reality domestically in the Americas.
So it really is a tale of two businesses split by geography. International did okay, but the Americas,
which still represents 70% of their Q2 revenue, so it's the core engine, is stalled. Net revenue in the Americas only squeaked up by 1%. But the really critical metric, comparable sales.
Don't tell me.
Comparable sales decreased by a shocking 4%.
Minus 4%.
Minus 4%, or minus 3% if you adjust for currency fluctuations. Either way, a 4% comp sales decline in your dominant core market, That is an immediate flashing red warning signal for any retailer.
No wonder the market panicked. And management owned up to it, didn't they? They admitted there was an internal reason.
They did. To their credit, the CEO, Calvin McDonald, admitted being, quote, disappointed with our U.S. business results. And he pointed the finger squarely at a product strategy failure.
They said the assortment had become stale.
Exactly, particularly in those really visible, high-volume lounge and social categories. Basically, their product development cycles just ran too long.
They got caught out by changing trends.
Completely flat-footed by the speed of fashion. You know, for years, that tight performance fit look, Lululemon's signature, reigned supreme in athleisure.
Right.
But fashion shifted, and shifted rapidly towards baggy, oversized silhouettes, think looser fits, wider legs.
And Lululemon's development cycle, which was all about perfecting those technical fabrics like Luon and Nulu.
Which takes time.
That couldn't keep pace.
Couldn't keep pace at all. Competitors like Alo Yoga or Burry, they were much quicker to respond to that shift towards baggy. It just proves that even a premium brand, maybe especially a premium brand, needs product agility today.
Okay, so you've got this internal stagnation problem, which is already bad, probably demanding discounts to clear out old inventory. But then Lululemon got hit simultaneously by this massive external structural shock. You called it the tariff time bomb.
Yeah, and this is a direct hit to their profitability. It absolutely crushed their margin outlook for the year.
Because it messed with their logistics, right? Specifically that de minimis rule change.
Exactly. It's devastating because it hits their established and previously very efficient logistics model right where it hurts. So de minimis. Previously, U.S. Customs allowed imports valued under $800 to enter the country duty-free. No tariffs. And Lululemon, being strategically savvy, had actually built its U.S. e-commerce fulfillment system to take advantage of this. They fulfilled a large chunk of their U.S. online orders from their distribution centers up in Canada.
Ah, clever. Shipping from Canada, under $800 value, no U.S. import duty.
Precisely. But then the rules changed. The exemption was removed quite suddenly, and that logistical advantage instantly became a crippling liability.
Because suddenly all those shipments were subject to import duties.
Substantial import duties.
Yeah.
And the cost is just massive. The company itself estimates this sudden, unavoidable external shock will reduce their gross profit by approximately $240 million.
$240 million. Yeah. Just gone.
In fiscal 2025 alone. Just wiped off the gross profit line because of a change in customs regulations.
Wow. That explains a lot about the stock reaction.
It does. And that number forced them to issue a catastrophic revision to their full-year gross margin forecast. Now, gross margin, that's your revenue minus the cost of the goods you sold.
And Lululemon's was always really high, right? Like close to 60%.
Historically phenomenal for retail, yeah. Often near 58%. They initially guided Wall Street for just a small decline this year, maybe 110 basis points or 1.1%.
Okay, manageable.
Manageable, but now, because of the tariff hit, they expect a massive 300 basis point contraction. That's a full 3% drop in gross margin.
Okay, that margin revision, that's precisely where the real fear must have entered the stock price.
Yeah.
It just guts that core profitability model that used to justify the super high PE ratio.
Absolutely. And there's another layer of risk here, too, related to trade. Their production footprint makes them highly vulnerable to geopolitical tensions.
Where do they actually make most of their stuff?
The sources show the vast majority relies on Southeast Asia. We're talking 40% in Vietnam, 17% in Cambodia, 11% in Sri Lanka, another 11% in Indonesia.
So basically all concentrated in one region.
Pretty much. That means about 86% of their products face potential tariff pressure, adding cost to nearly everything they sell in the U.S. in that region.
Okay, so management is facing this impossible strategic choice now.
Completely trapped.
The internal problem? The stale product, the declining U.S. demand that screams lower prices, run promotions, clear the inventory.
Right, you need to stimulate demand.
But the external problem, that $240 million tariff hit, screams raise prices, protect your margins.
Exactly, you need to pass that cost on, so what do?
They're damned if they do, damned if they don't.
Pretty much. If they absorb the tariff costs to protect sales volume in the U.S., they permanently gut that premium high-margin model that Burry is supposedly betting on.
Right. They become less profitable.
But if they raise prices to protect profitability, they risk accelerating that already worrying 4% comparable sales decline in an already cautious U.S. market.
Making the demand problem even worse.
This is the structural headwind. This is the rock and the hard place that the market is currently pricing in at that, well, fire sale PE of 11.
Okay, so if the stock is down nearly 60%, you could argue the market has fully priced in that U.S. crisis and the tariff hit, maybe even overpriced it.
That's the potential bull case argument, yes.
Which brings us squarely to that bull case, the core of Michael Burry's potential investment thesis here. It seems to rest on Lululemon's ability to execute its big strategic plan. What is it called? The Power 3 Act 2 strategy.
That's the one. The goal is basically to double their 2021 revenue, get it up to $12.5 billion by 2026.
Ambitious.
Very ambitious. And it really requires them to succeed on two major fronts, expanding internationally and growing their menswear business.
Okay, so let's go back to that tale of two companies idea from the Q2 results.
Right, because while the Americas were hemorrhaging, with comp sales down 4%, the international business was absolutely soaring. International net revenues surged 22%.
22%.
Or 20% if you strip out currency effects. And international comparable sales, remember, that underlying growth metric grew by a massive 15%.
15% internationally versus minus 4% in the Americas. That's a huge divergence.
Huge. 13% growth in constant currency internationally. It really suggests the brand itself isn't fundamentally broken everywhere.
It's more like it's facing saturation and maybe some specific logistical headaches in its oldest, most developed market, the U.S.
Precisely. And the key growth pillar within that booming international segment is China.
Right. The strategy seems simple enough. Just rinse and repeat that original three-pillar winning formula in this massive and seemingly very receptive market.
And the numbers really back up that long runway potential in China. In Q2, mainland China revenue grew an impressive 25%.
25%.
24% constant dollar. And comparable sales there were up 17% or 16% constant dollar. Still incredibly strong growth.
And if you zoom out, look at the whole latest fiscal year.
China revenue just exploded, up 41.3% year over year. And China now contributes almost 13%, 12.9% to be exact, of total company sales. It's becoming a really significant chunk of the business.
And the opportunity there is mostly about scale, right?
Yeah.
Compared to the competition.
Absolutely. We noted in the sources that Lululemon currently has about, 151 stores in China?
Okay. Seems like a decent number, but...
Yeah. But compare that to Nike. Nike has over 2,500 stores in the region.
2,500. Okay, that puts 151 in perspective.
It really does. This isn't a market where Lululemon is mature and fighting for tiny bits of market share. They are still in their relatively early stages of market penetration.
So even if they only got to, say, half of Nike's store count, that implies a huge, probably decade-long runway just for physical expansion.
Easily. And that's why, strategically, it makes perfect sense that the majority of all their planned new store openings for 2025 are focused squarely on mainland China. They're putting their resources where the growth is.
And this successful translation of the brand, not just in China, but even in places like Europe and Japan, where brand awareness is apparently still quite low.
Yeah, single digits in some places.
It kind of proves that the core concept, the premium product, the community feel, it still resonates globally.
It does. The international growth story really feels like it's still in its early innings, and that acts as a massive ballast against the current U.S. slowdown.
Okay, so international is one engine. What about the other key driver, the one outside their original women's yoga focus? You called it the sleeping giant of menswear.
Yes, because Lululemon is, I think, quite successfully transforming itself. It started as a niche women's brand, but it's becoming a genuinely dual-gender powerhouse in athletic and leisure wear.
And the numbers back that transformation up.
They really do. The men's segment revenue apparently has grown fivefold just between 2017 and 2024.
5 times.
Yeah. They're rapidly building this substantial second core business that isn't solely reliant on that original female yoga demographic.
And how much of the total business is menswear now?
It accounts for a pretty significant 24.2% of total revenue. And critically, it's their fastest growing major category right now, logging 13.6% year-over-year growth.
So it's not just a little side venture anymore, it's a dedicated engine.
Definitely an engine. And the growth isn't just incremental, selling more of the same stuff to men. It's being driven by real category expansion and creating iconic products for men.
Like the ABC pant. I hear about that one a lot.
Exactly. The ABC pant is a great example. It's become this iconic piece of functional, comfortable apparel for men. Plus, they're making a strategic push into specific activities like golf, tennis, running, areas where men spend a lot on gear.
And footwear too, right?
Yeah.
That feels like a big, bold move.
A very significant move into footwear, launching things like the Cityverse casual sneaker, the Beyond Feel running shoe. They're directly challenging legacy giants like Nike and Adidas on their most prized turf sneakers.
That's ambitious.
Hugely ambitious. But if they can successfully replicate that premium positioning they achieved in apparel within the menswear footwear category, well, that represents potentially billions in future revenue.
Billions that crucially aren't dependent on fixing that struggling U.S. athleisure inventory problem.
Exactly. So this ability to leverage their premium brand into new geographies like China and into new categories like menswear and footwear, all while hopefully maintaining those high margins abroad, that's the kind of compounding power, that optionality that a deep value investor like Michael Burry is often looking for.
Okay, so management clearly recognizes the urgency here. The U.S. product is stale, the competition demands speed, they can't just sit back.
No, they have to react. And they've unveiled a pretty aggressive, you might even say radical, strategy to address this stagnation. They're basically moving away from that traditionally slow, deliberate Lululemon product cycle.
How are they doing that?
The core response seems to be embracing a kind of fast fashion operational agility, if you will. They plan to significantly increase the proportion of new styles being introduced.
Newness. More new stuff faster.
Exactly. They want to get that percentage up from the current 23% of the total offering to approximately 35% by next spring.
35% newness. That sounds like a fundamental overhaul.
It is. It requires rethinking their entire creative pipeline, their supply chain. It means introducing basically 50% more new styles into the system, much more frequently.
And technology is central to making that happen, isn't it? They made a big hire.
A major technological pivot, yes. They appointed a new chief AI and technology officer, Ranju Das, and gave him an extremely clear mandate. Use artificial intelligence to essentially re-engineer the creative and operational process.
Re-engineer how? What's the goal of the AI?
The mandate is very specific. Use AI to, and I'm quoting here, expedite our product innovation process, improve our agility and speed to market, and increase personalization.
Okay, so faster innovation, faster to market, more tailored products.
Essentially, yes. They're attempting to move from a culture that relied heavily on human intuition, designer feel, those long controlled development cycles that perfected fabrics like Nulu,
Right.
towards a much more data-driven system. One that predicts trends using algorithms, optimizes inventory levels automatically, and speeds up the actual design process itself.
But this big push for acceleration for massive scale, it comes with some pretty significant risks. And this is where that cultural critique from the founder, Chip Wilson, feels really relevant. It highlights what you called the paradox of scaling.
Exactly. Wilson, the man who arguably built the original Lululemon culture, he issued a very public, very stark warning recently. He said Lululemon is, quote, losing its soul.
Strong words from the founder.
Very strong. He argued passionately that the very things needed for global growth, the institutionalization, the processes, the culture of scale had started to replace the creative, technical spark that actually built the premium brand in the first place. He even coined a term for it, GAP-ification.
GAP-ification, that paints a picture. What did he mean by that, practically speaking? Just too many different products.
It was really about a dilution of focus, according to him. Wilson's critique suggested the brand was shifting its core emphasis away from that perfect technical performance, the thing that justified the price, towards just broad commercial appeal. And that manifests as, yes, maybe too many non-core products, too many colors of everything, too many collaborations that don't quite fit, and ultimately maybe sacrificing that technical fabric edge for just mass accessibility, trying to be everything to everyone.
So his point was basically that the tight control and the long development cycles, the things that were the original Moat, are now seen internally as constraints because they prevent the speed the market demands.
Precisely. And you can actually see that strain starting to show up clearly on the balance sheet now, which kind of adds weight to Wilson's cultural argument.
How so?
Well, look at the inventory issue. Scaling up this fast has brought major operational strain. Inventories ballooned 21% year over year to $1.7 billion in Q2 2025.
That's a big jump.
It is. And on a unit basis, it was up 13%. That kind of spike strongly suggests inventory is turning over much slower. product isn't selling through as quickly.
Which forces them to do what? Markdowns.
Exactly. It forces management to accept markdowns, run sales, just to move the product off the shelves. And when a premium brand like Lululemon has to resort to significant widespread markdowns, that directly erodes the full price selling model, which is the absolute cornerstone of its high operating margin.
Okay, so inventory is one sign of strain. What else?
The diminishing returns on customer acquisition also scream operational stress. The cost to acquire a new customer, according to the sources, rose dramatically. It went from about $140 per customer in 2024 to over $230 in 2025.
Wow, that's a huge jump. It's getting way more expensive to bring people in.
Far more expensive. Which suggests either the market is getting saturated or competition is getting fiercer, forcing them to spend much more on advertising and promotions just to get noticed.
And we can't really ignore the big strategic missteps that happened during this recent push for scale either, can we?
No, definitely not. The highly publicized failure of the Mirror acquisition comes to mind immediately.
Right, the connected fitness device. They paid $500 million for it.
$500 million. And it was effectively written down, declared a failure within about 3 years. That's a perfect example of management maybe getting distracted by shiny objects, chasing growth outside its core competence of apparel.
And that kind of failure, it costs hundreds of millions directly. But it also drains management focus and time, doesn't it? Kind of validating the founder's fears about losing that institutional discipline.
It certainly lends credibility to that argument. So the company is now navigating this massive high-risk trade-off. They feel they must adopt the operational agility of a fast fashion company, using AI and faster cycles, to fix that U.S. product problem.
But they absolutely must do this without diluting the brand's core feel-first philosophy, that quality ethos that actually justifies the premium price tag in the first place.
It's a tightrope walk. The very culture that built the original Moat slow, deliberate, quality-obsessed is now potentially the roadblock to fixing the current crisis.
So management is betting big that technology, specifically AI, can provide the necessary speed without sacrificing the soul.
While the founder, Chip Wilson, is basically saying that the push for scale itself might have destroyed the soul already. It's a fundamental disagreement about the future of the brand.
Okay, let's try and synthesize all this information then. We have Lululemon trading at what looks like a generational low valuation.
Definitely the cheapest it's been in a decade, yeah.
The market clearly sees a broken U.S. business, fierce competition heating up, and this huge, unavoidable tariff bill looming over profits. So what is the core investment debate right now at this deeply discounted price?
Well, you really have two polar opposite viewpoints fighting it out. On one side, you have the bull case. This is the thesis that Michael Burry seems to be buying into.
Okay, and that thesis is?
That the business is actually still a structural powerhouse, just hiding some temporary pain right now. Bulls point to the fact that it still maintains fantastic average gross margins, historically near 58%. It boasts incredibly high returns on invested capital, or ROIC.
Which means they're good at making money from the money they reinvest.
Exactly. Averaging around 34.6% ROIC, which is excellent, and it operates with virtually no long-term debt on its balance sheet. So financially, it's still a very robust fortress.
So the bulls say, look past the current storm clouds.
Essentially, yes. And when valuation analysts try to ignore the current noise and do things like discounted cash flow analyses, trying to project future cash flows and discount them back to today's value, they often estimate the intrinsic value of the business significantly higher than where the stock is trading now.
What kind of range are we talking?
The sources mentioned ranges anywhere from, say, $231 up to maybe $271 per share, considerably higher than the current price. So Burry is likely betting on this underlying fortress eventually recovering its premium status and the stock price reflecting that higher intrinsic value.
Okay, that's the bull case. Very value investor driven. What about the bear case? Why is the market so pessimistic?
The bears argue the market's panic is actually completely justified. First, that $240 million tariff hit isn't temporary noise. It's an immediate catastrophic drain on profitability that's happening now.
It's real money disappearing.
Real money. Second, they argue the deterioration in the core U.S. market might not be temporary. It could be structural. Maybe the market is saturated, or maybe consumer preferences have permanently shifted in ways Lululemon can't easily reverse, especially with nimble competitors.
So the U.S. business might never fully recover its former glory.
That's the fear. And critically, the bears emphasize that the turnaround isn't expected to be immediate, even if management's plan works.
Yeah.
Analysts warn that the actual inflection point, the moment you'd see revenue and margins start to improve because the new AI-driven product cycle is succeeding, isn't expected until spring 2026 at the earliest.
Spring 2026, that's still quite a long way off.
It is, and that long wait means potentially many more months of continued inventory pressure, more markdowns, more uncertainty, and that is the classic value trap concern, isn't it?
Right. Is it cheap because the market is being irrational and overly fearful?
Or is it cheap because the underlying economics of the business really have permanently deteriorated and the stock deserves to be cheap?
Which brings us right back, full circle, to Michael Burry's calculated risk, signaled clearly by him doubling his stake in that latest 13F filing.
He's essentially placing a very high-confidence bet, it seems, that the U.S. weakness and that tariff shock are just temporary noise. Noise that's masking a durable, highly defensible business model underneath.
He's looking past the current margin squeeze.
Looking past it and focusing on the underlying assets. Those IP-led proprietary fabrics that still command loyalty. The superior store economics that come from vertical integration, and maybe most importantly, that massive, still underappreciated international runway.
Especially China and the potential in menswear.
Exactly. He likely views this as a very high-quality asset that is currently being priced by the market like distressed garbage. A classic Burry setup, perhaps.
So he's betting that the premium pedigree Lululemon built over decades, that ability to command price, to maintain high margins, is fundamentally strong enough to weather these two enormous shocks hitting it simultaneously. The internal product stagnation and that external tariff pressure.
Yeah, that seems to be the bet. And that leads us directly to the central, maybe provocative question for you, the listener, to really consider after hearing all this.
Okay, what's the final thought?
Lululemon built its entire brand, its entire premium status on being somewhat immune to price competition because of its technical quality, its unique feel, that community connection.
Right, that was the moat.
That was the moat. Now, management is aggressively using AI and speed, trying to mimic the operations of a fast fashion giant, in some ways to solve the current product problem and gain agility.
The necessary pivot.
The necessary pivot, perhaps. But the core question is, will Lululemon's attempt to graft speed onto its model risk destroying the very soul and the quality-obsessed culture, Chip Wilson's big concern that made its premium pricing power possible in the first place?
Could sacrificing the original moat for short-term speed solve the current crisis, but fundamentally compromise the long-term value that Michael Burry is betting on?
That's the multi-billion-dollar question facing Lululemon, its management, and its investors right now.